Welcome to the debate. Today, we are immersing ourselves in the incredibly intricate economic simulation of Wadsworth. It's this highly complex, completely player-driven ecosystem that models financial mechanics with staggering and, almost punishing precision.
It really is. The level of detail is just wild.
Right. And today we're looking straight at the foundational code and the database architecture governing this world, but specifically from the point of view of a player actually trying to survive and, navigate this environment. The central question we're exploring today is this: are the autonomous banking entities in Wadsworth mere slaves to the government's systemic rules, or are they the true overlords dictating the reality of the simulation?
It's such a fascinating question. Because when you look past that surface-level gameplay and dig into the actual Python scripts and the database models, the corporate actions logic, the market engines, you realize just how hostile this environment is to the average user. We're really looking at who actually holds the power when a player logs in and tries to build a digital life.
Exactly. And looking at that architecture, my position is that the banks are structurally designed as subservient utilities. They are rigidly hard-coded to stabilize the state's economy and ultimately funnel wealth upward to the government, which exists in the code as player zero.
Well, I actually argue that the inescapable financial tyranny of these banks makes them the undeniable overlords. Through forced currency conversions, brutal solvency levies, and absolute credit manipulation, the banks really subjugate both the players and the state to their algorithmic will.
So to start, when we examine the foundational mechanics of Wadsworth from a player's perspective, I think it becomes overwhelmingly clear that these banks lack true agency. Their behaviors are entirely hard-coded to serve macroeconomic stability rather than their own institutional profit or power. Take the quantitative easing, or QE, mechanics found in the ETF and land banks. In the real world, QE is a complex policy tool, right? But in this simulation, it means algorithmically forcing the bank to print assets just to save the market. These institutions essentially act as sacrificial shock absorbers for the government's economy.
Sacrificial is a very generous word for what they do to the players, though.
But look at the triggers. If the land bank's share price crashes down to a specific prices threshold, specifically if it hits negative $49.99, the bank is forced to trigger emergency discounted land auctions. It literally prints land out of thin air to restore its net asset value, trying to get its baseline worth back above water.
Yeah, it dilutes the whole market.
Right. But the Energy and Appleseed's ETFs do the exact same thing. When their shares collapse, they're forced to spend their reserves buying up oversupplied commodities. They don't do this to enrich themselves or to dominate the player base. They do it because the state's code demands they save the market. Ultimately, all roads lead to player zero, the government. As a player, you see the state passively collecting immense wealth everywhere you turn. They take property taxes, they skim 50% of county crypto exchange fees, and they hold the absolute power of asset seizure during a player's estate liquidation. The banks are really just the plumbing, moving the player's wealth to the state's reservoir.
You call them plumbing, but from down on the ground where the players actually live, those plumbers are armed and charge a toll at every single pipe. You have to consider what this ecosystem actually feels like. The banks wield an absolute terrifying authority that even the government can't bypass. Look at the reserve banks. They hold a total monopoly on foreign exchange.
True, they do handle all the forex.
And if a player engages in a cross-currency trade, it triggers an automatic, mandatory forex conversion. The bank extracts a 0.2% fee without any player consent. There's no manual opt-out, there's no workaround. But honestly, the fees are nothing compared to the insolvency mechanics.
You're talking about the solvency levies.
Exactly. When a bank like the land bank or an ETF fails, when its reserves actually drop below zero, it doesn't die. It survives by cannibalizing the player. It issues what the code explicitly calls solvency levies, forcibly garnishing up to 50% of a shareholder's available cash every 60 seconds.
It is quite aggressive.
It's completely ruthless. Can you imagine logging in after a weekend away and finding out a bank turned you into a human battery to pay off its own debt? And if the player can't pay, the bank slaps a lien on them that accrues compounding interest at up to 5.3% annually. That breaks down to 0.01% per minute. That isn't the behavior of a subservient utility. That is the behavior of an apex predator feeding on the user base.
You call them an apex predator. But let's look at what actually happens when they hunt and fail. The illusion of their supremacy completely shatters when you analyze the city banks. If a city bank fails to make its loan repayments to the government, what happens? It doesn't get to cannibalize the state. It's subjected to a forced bailout spiral. The system forces the insolvent Citibank to take an emergency government loan equal to 1.5 times its shortfall.
Right, the bailout mechanic.
Yes, and imagine being a bank and the government forces you to take a massive loan at a 7% interest rate just because you stumbled. You were trapped in a 30-installment debt spiral. The government directly profits from the bank's failure.
But that's a municipal-level entity, it's not...
It scales, though. Furthermore, the government automatically distributes 2% of its total reserves as grants to these city banks every 12 hours. The code strictly dictates this welfare system. So, as a player, you might feel oppressed by a city bank, but that bank is entirely dependent on state handouts just to keep its doors open. When they fail, they are shackled with punitive government debt. They are fundamentally subservient to Player Zero's overarching financial structure.
You're focusing heavily on municipal entities and ignoring the broader institutional power of the macroeconomic pillars, like the land bank, the ETFs, and above all, the brokerage firm. You want to talk about who really holds the power over a player's digital life. The brokerage firm operates as the ultimate gatekeeper. It dictates credit scores, it controls access to all initial public offerings, and it enforces margin calls. And we all know the dread of a margin call. When your account value drops below the broker's required minimum, they demand you deposit more cash immediately, or they start liquidating your portfolio.
Which is standard financial mechanics, not necessarily tyrannical overlord behavior.
Until you look at their liquidity triggers. If the brokerage firm's cash reserves fall below its $50 million minimum operating threshold, it doesn't go begging the government for a 7% loan like a Citibank. It simply suspends its services. It freezes IPO underwriting, halts margin trading, and stops commodity lending. The bank effectively holds the entire economy hostage, freezing capital markets until its own liquidity recovers.
But that's just self-preservation.
As a player trying to run a business, this is devastating. The state can collect all the taxes it wants, but if the brokerage firm decides to shut its doors, your ability to leverage capital completely evaporates. You are stuck. The bank dictates the pace of the entire simulation's economy, and the government can do absolutely nothing to force them back open.
The brokerage firm halting operations isn't an exercise of hostage-taking power, though. It's a hard-coded safety mechanism designed to prevent systemic contagion. It shuts down because it's programmed to protect the integrity of the market, not to extort the state or punish the player. And if we look at market control and currency manipulation, the algorithms prove my point. Look at the reserve banks, which you mentioned earlier as holding a monopoly on Forex. Their yields are entirely dictated by algorithmic supply and demand. They are constrained by the net flow of the Wadsworth stablecoin.
Constrained by the flow, sure, but
Mathematically bound to it. If the net demand is positive, meaning more players are buying bonds than redeeming them, the algorithmic yield falls. If demand is negative, the yield rises. They cannot arbitrarily set their own monetary policy to squeeze the players. They are mathematical slaves to market forces and the state's overarching design. And how does the state exploit this? The architecture includes a function that runs every 12 hours, automatically sweeping any excess government cash, anything over $100,000, into the best-yielding reserve bonds.
Right, the auto sweep.
Exactly. So the state actively leverages the bank's algorithmic constraints to continually enrich its own treasury. The player does all the work, the bank crunches the numbers, and the government scoops up the profit.
You claim the banks are bound by algorithms, but you're completely glossing over how aggressively the banks manipulate the players to prop up those very algorithms. Let's look back at the city banks. They don't just sit there passively waiting for market forces to dictate their yields. They enforce a strict 10% reserve requirement on all city members based on the player's total net worth.
Right, to ensure local liquidity.
To force compliance. If a player's holdings in the city currency fall short of that 10% threshold, the system doesn't send a friendly warning. The city bank automatically buys the missing currency on the open market, using the player's own funds, and then charges the player a fee for the privilege. Think about how infuriating that is from the player's point of view.
It is definitely a pain point.
The banks literally force you to hold their specific currency. They use your wealth to artificially prop up their net asset value, meaning they use your hard-earned cash to ensure their own baseline worth stays afloat and to maintain continuous demand for their currency. The players are a captive audience to the bank's aggressive monetary policy. The bank doesn't care about your personal investment strategy or your liquidity needs. It extracts compliance automatically.
You're conflating localized coercion with ultimate authority. Yes, a Citibank can enforce a reserve requirement on a player, and yes, it's incredibly annoying to get hit with auto-buy fees. But what happens to the player's total accumulated wealth in the end? If we're talking about who really owns the player, we have to look at the estate and bankruptcy mechanics. When a player declares bankruptcy, or more commonly, if their account is simply deleted after 30 days of inactivity, the government seizes absolutely everything.
Well, account deletion is the end of the line anyway.
But look at the sheer scale of the liquidation. The player's land is immediately ceded back to the state. Their inventory is liquidated to the government at a massive discount. Their shares, their businesses, their districts, all of it defaults to player zero. If a player dies in the simulation without heirs, the government keeps all the cash. Even if they have heirs, the state extracts a 15% death tax. The banks may charge fees and enforce reserve ratios while you're actively logging in and playing, but they are merely facilitating an economy where all roads eventually lead to the government's treasury. The banks are just the workers tending the field. The government owns the harvest.
That is an elegant way to frame it, but it fundamentally misunderstands the mechanics of money creation within the simulation. Yes, the government plays the Grim Reaper at the end of a player's life cycle, but while the economy is actually breathing, while the player is online trying to build an empire, the banks control the very fabric of reality. Let's examine the interbank bond swap mechanic. This is perhaps the most powerful piece of code in the entire Wadsworth simulation. When a reserve bank runs low on foreign reserves, specifically falling below 5% of its outstanding liabilities, it doesn't go bankrupt. It doesn't get liquidated by player zero.
It triggers a swap. It automatically forces a swap with another bank. It issues its own bonds to acquire reserves from that target bank, and the target bank is forced to hold those liabilities. The banks have the absolute power to create money out of thin air, issue debt, and force other macroeconomic institutions to absorb it. The government collects taxes based on the rules of the game, sure, but the banks write the fundamental reality of value. They leverage players as mere batteries to fund their automated operations, to generate the fees that pay their dividends, and to sustain their endless automated interbank debt cycles. The state is just a passive beneficiary of a system the banks actively govern.
You talk about the interbank bond swaps like it's a conscious exercise of sovereign power. But we have to remember that this money creation is a highly regulated algorithmic trigger designed to prevent systemic collapse. The banks are trapped in a deterministic loop. If reserves drop below 5%, the swap fires. It's an autonomic reflex. Furthermore, any interbank debt created by these swaps incurs what the code calls a yield penalty. Basically, the debtor bank's yield rises by 0.1% for every $1,000 of net debt.
Which pushes the burden onto the market.
Exactly. It mathematically forces them to offer better returns to the market to cover their balance of payments gaps. The system constantly disciplines the banks. They are constrained by a mathematical gravity, established by the simulation's creator, the ultimate state power. The government, conversely, operates with supreme unilateral authority. It can banish players, it can seize property, and its grant systems are what keep the foundational municipal economies from collapsing in the first place.
But the discipline you're describing is exactly what makes the banks so terrifyingly powerful over the players. You're right that the banks are responding to algorithmic gravity, but they pass the crushing weight of that gravity entirely onto the player base.
When the yield penalty forces a bank to adjust, or when insolvency triggers those quantitative easing mechanisms we discussed earlier, who actually pays the price? The player does. The brokerage firm enforces margin calls with ruthless efficiency to protect itself. If a player's equity drops below the maintenance requirement, the firm automatically liquidates the player's shares at market price until the debt is covered. There is no negotiation. You can't appeal to a customer service rep. The bank protects its own solvency by instantly liquidating the player's assets.
That's the nature of margin, though.
Yes, but you argue that the government has supreme authority because it seizes assets upon bankruptcy. Who pushes the player into bankruptcy in the first place? It's the cascading weight of bank-enforced reserve requirements, compounding lien interest from solvency levies, and sudden margin liquidations. The state might act as the undertaker, but the banks are the executioners.
It's absolutely true that the banks serve as the immediate proximal cause of much of the financial friction players experience. It is a brutal gauntlet. To summarize my perspective, though, when we look at the structural architecture of Wadsworth, the banks ultimately function as rigidly programmed utilities. They are heavily regulated by state-designed mechanics like mandatory quantitative easing, yield penalties, and forced bailout loans. Their entire existence is predicated on absorbing economic shocks and facilitating a hyper-taxed environment where wealth is ultimately, inevitably funneled up to the government's treasury, player zero. They are powerful, yes, but only in the way a turbine is powerful. It spins only because the state's river flows through it.
And to summarize my stance, from the perspective of the player actually logging in, trying to survive and build wealth in this simulation, the banks wield unparalleled, inescapable power. They enforce automatic forex fees, they execute brutal garnishments and compound interest during their own insolvencies, and they impose strict mandatory reserve requirements that force players to buy specific currencies just to exist in a city. They can freeze the entire capital market if their reserves drop, and they can conjure money to force other institutions to carry their debt. The government may have established the parameters of the world, but the autonomous banking entities are the aggressive, unyielding overlords that dictate a player's minute-to-minute reality.
Despite our different framing, there is a clear point of convergence here. Both of us agree that the architecture of the Wadsworth simulation features an incredibly sophisticated and punishing relationship between state authority and financial power. The government sets the overarching, inescapable rules of death, taxes, and final liquidation, while the banks act as the aggressive, autonomous enforcers that players have to actively navigate and survive on a daily basis. The lines between municipal governance and central banking are deliberately blurred, creating a uniquely hostile but absolutely fascinating economic sandbox.
It really is a masterpiece of design. The level of detail in the database schema, from the way interbank trades are logged to the specific mathematical triggers for quantitative easing and margin calls, perfectly mirrors the real-world tensions between central monetary authorities and state governments. It forces the player to ask incredible questions about whether true autonomy lies in the power to tax or the power to control the money supply and issue debt.
The simulation offers a profound reflection on macroeconomic realities, experienced directly through the stress of gameplay. For anyone engaged with the material, there is so much more to explore in how these mechanics impact specific player strategies, whether one chooses to hoard stablecoins, heavily leverage through the brokerage firm, or attempt to isolate themselves entirely in decentralized counties to avoid the city banks.
The mechanics are so deep that every player basically has to form their own unique survival strategy to handle the dual pressures of the system.
Thank you for joining us for this analysis. We will leave it to the listeners to form their own conclusions on the architecture of Wadsworth and to decide for themselves whether they fear the state's absolute taxation or the bank's relentless solvency levies more.